Okay, hi everyone, I'm James Hart and welcome to this Orbex Trader Education session. So in today's session, we are going to take a look at what is a classic and indeed one of the most widely used trading methods, and that is of course breakout trading. Now, the beauty of breakout trading is that it is incredibly simple but also extremely powerful. And some of the world's biggest hedge funds have been known to employ very simple breakout strategies. So it's completely worthwhile spending some time getting to understand what this trading method is about and how you can use it. Now, although breakout trading is incredibly simple, it is often misused by new traders who struggle to trade breakouts effectively. So in today's session, I'm going to walk you through exactly what breakout trading is. I'm going to show you some specific strategies and setups, and I'm also going to talk about the traps that you need to be aware of and how you can protect yourselves against them. So as ever, if you have any questions along the way, please just write them in the chat function as we go along, and I'll stop periodically to answer them, and then we'll also have some time at the end. Okay, so first of all then, let's get right into it. What is breakout trading? So breakout trading is simply a method where we look to capture an expansion in price as it moves beyond either a defined high point or a defined low point. So this is the basis of breakout trading, and this is why I say it's an extremely simple and straightforward approach to trading the market. So typically, traders will identify a trading range where price is rotating between a high point and a low point, and then they're simply looking to enter the market as price breaks beyond either that high or low point. Now, one of the key elements to successful breakout trading is in how you identify the range. Okay, so correctly identifying the range will put you at an advantage over other traders. Now, some of the classic ways to identify ranges are based on identifying highs and lows over certain periods, such as the daily high or the low over the last 20 days. So the last 20 trading days is roughly a month. So if you're looking at the daily high and low over the last 20 days on your charts, you're looking at roughly a month. Alternatively, if you're trading on the lower time frames, you can look to identify highs and lows over the last trading day or over the last 5 trading days. However, you don't necessarily need to base your ranges on specific time frames. You can also base them on support and resistance, so looking at the actual structure of the market itself. So you'll often find that the market at certain times forms these blocks of consolidation where price is trapped between a resistance level and a support level. And so this is why I say the basis of breakout trading is essentially looking to capitalize on the natural way, the natural ebb and flow that the market demonstrates, so moving between periods of expansion and periods of contraction. And obviously, it's the periods of expansion where we get our breakout trading opportunities. So let's take a look at a trading range then and talk about how we identify it and how we can look to capitalize on the subsequent moves out of that range. Okay, so in this image then, you can see we have an example of a classic trading range. So price is trapped between resistance at the top of the market, where we have a build-up of orders to sell, which we call supply. And then to the downside, you can see the market is underpinned by this support zone, and this is where we get a build-up of orders to buy called demand. So for those of you who were in the support and resistance webinar, you should be familiar with these terms, but if not, don't worry. Essentially, all we're looking to do is, when we pull up our charts, look to see if we get any highs or lows lining up. And where we do, we can go ahead and draw in our lines. So I say to the top side of the market, these lines denote resistance, and below the market, they highlight support. So once we've identified price is in a range, once we can see price moving up and down, trapped between a high and a low point, but not making any proper directional moves, then we know that we have a range in play and we can be on the lookout for a breakout opportunity. Now, the longer the range persists, the easier it will be to identify it, the easier it will be to actually establish the range, and the chances are the greater the breakout is likely to be. So as I say, once we identify a range in play, then we need to be on the lookout for a breakout opportunity. However, the issue is that we never know which way price is likely to break out. So we have a couple of options. We can either look to set orders either side of the range, so looking to set resting buy orders above the top side of the range, anticipating that price breaks out to the top side, or set resting sell orders below the bottom of the range, anticipating that price will break out to the downside. Or alternatively, we can look to monitor price and be a bit more active with our trading. So looking to assess the market as it breaks out beyond the boundaries of the range, and then making an active decision as to whether or not we want to engage in that move. Now, one of the first ways that we can improve on the traditional breakout method is by simply looking to trade with the trend. So this is something I've talked about in a lot of the sessions that we've done, whether we've been looking at specific strategies or using indicators. You'll hear me talking a lot about looking to trade with the trend. And this is essentially looking to align yourself with the dominant momentum in the market, as this greatly improves your chances of being on the right side of the trade. So how does this work for range trading then? Okay, because obviously once we're in this range, there is no trend, we're simply rotating higher and lower. So really what we want to look to do is, we want to look to identify which direction the market was moving in before we form the range. Okay, so for example, if the market is moving higher in a bullish trend, and then we form a period of consolidation like this, where we get our range, we can then look to trade to the top side, anticipating that price is going to break out and that the bullish trend is going to continue. Similarly, if the market was moving to the downside before we formed our range, then we can anticipate that the bearish trend is going to continue, and we should be on the lookout for trading to the downside as price breaks out below the bottom of the range. So trading in this manner keeps momentum on our side and gives us a far stronger chance of catching a proper move. So let's take a look at this in an example. Okay, so in this example then, you can see that price makes an explosive move higher. So we've got a really sharp, violent bullish move here. We trade all the way up to this high point here before you can see that we actually stall out and price starts to soften a bit and retrace lower. Now, to the downside, you can see that the retracement is capped at this point here. So we get an initial low here, and then we get a subsequent low here. And you can see to the top side, price is struggling to break out beyond this point. So once we've identified these two levels between which price is rotating, then we know that the bullish trend has paused for now and that price has settled into a trading range. Okay, so this simply highlights a contraction in the trend, so it's simply a pause, and then what we're looking to do is trade a breakout to the top side, anticipating that when this range resolves, the bullish trend is going to continue. Okay, so it's very simple. The market was moving bullishly into the range formation, so we know that momentum was on the side of buy orders. We then saw some equilibrium kick in between supply and demand. You can see that buyers and sellers settled down a bit, and the range formed. And so then what we're looking for is simply price to continue to the top side eventually and to break out above that range. So in terms of how we go about trading this, we have two options. The first is we can take a more aggressive approach where we simply set an order to buy above the high of the range. But the problem with this, however, is that it simply exposes us to some unnecessary risk, because the boundaries of these ranges can typically be quite volatile areas where price will often pierce and test orders above the range of the boundary, only to then reverse and suck you into what is known as a false breakout. Okay, and false breakouts are one of the main reasons why many traders, especially new traders, struggle with breakout trading. They're okay with identifying the range. They know that they want to be trading to the top side or the downside. However, they can't seem to get a handle on entering the trade, and they typically find themselves getting sucked in to losing trades where the market reverses on them and goes the other way. So to add more weight to our bias then, and to kind of mitigate against this risk, what we can do is wait for price action confirmation. So essentially, this means we will only look to enter breakout trades on a candle close beyond the range boundary. Okay, so for instance, in this example, we're looking to trade to the top side. So what we want to see is a bullish candle close above the top of that boundary to confirm that the breakout is in play. So we're looking to trade to the top side. We want to see price break above the boundary of the range. However, we want to protect ourselves against unnecessary risk and the likelihood of a false breakout. And so instead of simply entering long as price breaks out above the range, what we do instead is wait for a candle to close above that range high. And you can see here the first candle that does so is this green candle here, this bullish candle. Okay, so we get an initial candle that pierces the range high here, that comes back inside, but it's this green, this big bullish candle here, which is the first candle to close above the high of the trading range, and that's where we go ahead and enter our trade. Now, doing this doesn't necessarily mean that you won't ever get sucked into your false breakout, because of course there is no 100% winning strategy in the market and there will always be losers. However, what we're always looking to do is improve our chances of success, and we're always looking to manage our risk and protect against downside. So waiting for price action confirmation, trading with the trend, these are both examples of how you can improve your chances of success when trading with a breakout. Now, in terms of how we set stops and targets, the traditional approach is to place our stop on the other side of the range and aim for a minimum target of 2 times our risk. Okay, so where we're looking to buy as price breaks out above the range, we put our stop below the low of the range, and then we look to target 2 times our risk. Alternatively, we can look to be a little bit more strategic with how we place our stops, and we can look to use a structural approach whereby we assess the recent highs and lows in the market and look for a good place to put our stops. So for example, where we've got a breakout to the top side and we're going long here, we'd want to look at the last swing low in the market before the range was broken. Okay, so this is the last point where we saw buy orders kicking in that then drove price higher on that last move up to break the range. So if we're long here, we can go ahead and put our stops in just below these swing lows, and then again we're looking to target a minimum of 2 times our risk. So this is an example then of how we can just be a little bit more strategic and use a bit of our market savvy in terms of assessing market structure in order to get us a better risk reward on the trade. Because obviously if we reduce our stop size, then we reduce the amount of upside that we need in order to make our positive risk reward. Now, what we aren't doing is just arbitrarily picking a point and saying, okay, I want to risk 20 pips or I want to risk 30 pips. We're still looking at the market and assessing a good logical point to place our stop. Okay, so as you can see then, what I'm trying to get through to you is the process in which you can look at the market and identify these ranges and then go about building your trade idea in terms of entering the trade and also in terms of setting stops and targets. Now, so far we've looked at trading breakouts simply on a naked price action basis, but we can also use indicators to help us identify ranges and also to help us trade the breakouts. And one of the best indicators for this is actually the Bollinger Band indicator. So for those of you who have been in some of the technical indicators webinars we've done in the past, you should hopefully remember this indicator, and I'm sure quite a few of you will be familiar with it anyway, but if not, don't worry, I'm going to talk you through exactly now how we go about using this indicator. So you can see the Bollinger Band indicator on your charts then. It's this big sort of green bubble that's wrapped around price. And you can see that we have three lines rather. We have a line that runs through the middle of price, a line that runs to the bottom of price, and a line that runs to the top. So essentially, what this indicator is doing is highlighting volatility in the market and also giving us an idea as to the direction of the trend. So it works off a series of moving averages. So the middle band that you see is a 20-period moving average. The upper band is then 2 standard deviations above that average, and the lower band is 2 standard deviations below that average as well. Okay, so most people will look to trade Bollinger Bands simply by trading a breakout as price either breaks below the lower band or above the upper band. However, this tends to be quite an ineffective way to trade them, because what we tend to see happen a lot of the time is price piercing the outer limits of the Bollinger Bands before reversing. And this is because these outer lines are highlighting where volatility is overstretched and likely to see some contraction rather. So instead, what we can look to do is combine Bollinger Bands with our understanding of support and resistance, structural support and resistance, and this will give us a much better chance of catching a proper move. So essentially, with this method, what we're looking to do is identify a range in price where the market is rotating between a high and a low point, and this will be clearly identified by the Bollinger Bands, which will be moving in a rather flat fashion, highlighting rather that there's no specific direction in the market, and we should see price bouncing off the upper and lower bands. And then what we want to do is identify price breaking either the high or low of the structural range, as well as breaking out of the Bollinger Bands to signal a shift in momentum. So let's take a look at an example then, and I'll walk you through this in a bit more detail. Okay, so in this example then, you can see that price is clearly framed in this range. We have our resistance levels to the top here, and then we have our support levels to the bottom. So price is simply rotating higher and lower within this range, and you can see that the Bollinger Bands have turned quite flat, rotating higher, price rotating higher and lower within them, identifying that there is no real directional move in the market and that there's a lack of momentum. However, you can see at this point here that two things happen. So one, for the first time, price has broken the range on a closing basis. And secondly, we've actually broken out of the Bollinger Bands. So the confluence of these two elements confirms the bearish breakout. Okay, so as I say, we identify our range, we identify our support and resistance levels, and then we look to wait for price to break out of those levels. But then in this instance, we're also looking for price to have broken the Bollinger Bands. So it's the confluence of these two elements which tell us that this is going to be a short entry to the market. And then once again, you'll see I mentioned we wait for the range to be broken on a closing basis. So we'd only look to enter short on the close of this bearish candle. And we mentioned earlier the importance of waiting for a candle close beyond the range boundary to avoid false breakouts. And if you look up here, you can actually see an example of why this is such an important aspect of breakout trading, because in this instance, price did indeed shoot up and break out above the range high, and traders taking a more aggressive approach could have been sucked in here on a false break. However, while we're waiting for a candle close, you can see that price didn't in fact close above the range. It shot back down and closed inside. So for those traders being a bit more conservative and waiting for a candle to close outside the range, this wouldn't have been a trade to take. Now you can also see the importance of using the Bollinger Bands in conjunction with support and resistance and how effective they can be, because once again, although price broke out of the Bollinger Bands, you can see it quite quickly came back down inside. So there was no continuation in this move. Price came up on this candle here, and on the second candle came straight back down and closed inside the Bollinger Bands. So looking at both structural support and resistance and looking at the Bollinger Bands can be a really effective way of building a multi-layered view of the market and helping you to get into better trades and helping you to stay out of poorer trades. Okay, now so far we've looked at how you can trade breakouts of static ranges, e.g. ranges defined by a horizontal high and low, by horizontal support and resistance. However, you can also trade breakouts of dynamic ranges, essentially ranges that are defined by structures which are developing, such as a channel or other patterns. So hopefully, for those of you who can remember the sessions we did on trend lines, channels are essentially structures that form when price moves between two identical trend lines that form support and resistance. So to identify a channel, we simply first establish a trend line and then clone it to apply it to the other side of price. So let's take a look then at an example of this, and again I'll talk you through this in more detail. Okay, so in this example, you can see that we have a clear bearish trend. So we identify our bearish trend line, running it along the top of price, joining these two highs. We then clone it, move it to the downside of price, and you can see it picks up these swing lows perfectly, acting as support. So we've got our bearish channel in play. It's a classic technical structure. Price is moving to the downside within this channel. However, whenever we see a channel like this developing, we can always be on the lookout for an opportunity to trade a reversal in price, because as we know, these moves don't always go on forever. And especially when we start to see really well-defined technical structures such as channels forming, there's always the risk that the channel is going to break and price is going to reverse. Now, channel breaks can be a fantastic way to catch reversals in trends. And the way that we enter trades on channel breaks is the same as how we enter breaks of any typical range. So we're looking to wait for a candle close outside of the range. So in this instance, you can see that from this point here, price started moving higher, grinding its way up to the channel. And then at this point here, you can see this large green bullish candle broke above the top of the channel resistance line, and then we closed outside of the channel for the first time. Okay, so this was actually the first time that we'd broken outside of the channel in about 2 months. So this was an important technical development. So we can go ahead and enter long here on that candle close above the channel high. And then again, what we're looking to do is place our stop either below one of the structural lows or below the low of the channel, and then we're looking to target a minimum of 2 times our risk. But essentially here, what I'm trying to show you is the way that we can look to trade breakouts of dynamic structures in the same way that we trade breakouts from traditional static structures. Now, one of the things that we can also do to improve our chances of success is, again, we can use indicators in conjunction with these structures to improve our chances of catching reversals. Now, a really great indicator for use in instances such as this is the RSI indicator, so the relative strength index. And this can help us spot when momentum is waning in the market and when a channel is vulnerable to a reversal. So if we look at this image again, this time with the RSI indicator turned on, and you can notice something really interesting. So look what's happening here then. As the channel is developing, you can see that price is pushing to the downside, as we'd expect, making lower lows. And then you can see here, the indicator is confirming the bullish momentum in the market. So as the indicator, pardon me, so as the indicator is, so as price rather is making these new lows, you can see the indicator is also putting in these new lows. So we could draw a diagonal line, then that would show these new lows forming. And this shows us that bearish momentum is increasing in the market and sellers are growing in power. However, what you can also notice is that from this point here, as price, from this point here rather, as price continues to put in new lows, the indicator is actually starting to put in higher lows. Okay, so price is putting in new lows, moving to the downside. The indicator is putting in higher lows, moving to the upside. And this is telling us that there is a potential shift on the horizon in the market. So sellers are losing momentum and buyers are starting to build momentum. So whenever we see this happening, we can be on the lookout for a bullish reversal. Okay, so price is moving to the downside in this bearish channel. The indicator is putting in higher lows, showing us that selling pressure is weakening. And then we know that this channel probably doesn't have much longer to go. So once we identify this, and what we call this is bullish divergence. Divergence simply refers to a situation where the moves that we're seeing in price aren't supported by the indicator. So again, just to reiterate, the price is continuing to make new lows in line with the bearish channel, but the indicator is telling us that selling pressure is weakening and buying pressure is starting to build, and this is reflected in the indicator starting to put in higher lows and move to the top side. So once we identify this bullish divergence, all we need to do is monitor price and wait for it to break above the top of the channel, and then we can go ahead and take our trade. Now, alternatively, if this was a bullish channel, we'd be looking for bearish divergence. So we'd be looking for price to continue making new highs, but the indicator to start putting in lower highs. And this would signal that buying momentum was weakening and selling pressure was building, putting us on alert for a bearish trade. So the RSI indicator then, a fantastic indicator that you can use in conjunction with structures such as channels to help you identify when the market is vulnerable to a reversal and then pinpoint where it is that you need to get in the trade. Now, channels aren't the only dynamic structures we can trade. We can also trade breakouts of patterns, and one of the best patterns to trade breakouts from is the triangle pattern. Okay, so again, for those of you who were in the chart patterns webinar, hopefully you'll remember the triangle pattern. It's a classic consolidation pattern formed by two converging trend lines, and it highlights a contraction of momentum in the market. And breakouts from these patterns can often be extremely volatile, so these are really good patterns to be on the lookout for as breakout traders. And the great thing is with all of these, which I should mention, whether you're looking at trading channels or static ranges or triangles, patterns, is that you can use them on all time frames. So whether you're a much higher time frame position trader or you're an intraday scalper, these technical structures are valid on all time frames. So you can apply them to your breakout trading no matter which time frame you like to trade on. Okay, so let's get back then and take a look at an example of trading triangle breakouts. Okay, so you can see in this instance then, we had an explosive move to the top side here. We had this really strong bullish move. We then stalled out at this point here. We put in two highs. We moved lower to this point before buyers kick back in again. And then here you can see our triangle forms. So as price is chopping around in this range, not breaking this low, not breaking this high, you can see that we're able to apply two converging trend lines which join these falling swing highs and these rising swing lows to give us our triangle. Okay, so once we see this triangle once we see this triangle happening, what we know then is that the market has lost momentum, lost volatility, and is contracting. And so once again, as we saw when we were trading static ranges, how we can look to capitalize on this is by anticipating a move in line with the initial move that we saw occurring into the formation of the triangle. So to put that simply, you can see here the market was moving in a bullish trend before volatility and momentum contracted, and that's where our triangle occurred. So we can anticipate that the market is going to break out to the top side again at some point, and we can wait and look to trade a breakout to the top side. Okay, and so you can see again, what we're always looking to do is wait for a candle close outside of the range in order to go ahead and enter our trade. So in this instance, we go ahead and get long here on this bullish candle that closes above the top of the range high. And then again, we can either put our stop below the low of the structure, or we can be a bit more strategic with it and put it below the last swing low. So if we'd entered long on this candle here, our stop would be below that last swing low in the market. And then we're simply looking to target 2 times our risk as price breaks out to the top side. So as you can see then, this is a fantastic sort of structure that you can use to identify breakout opportunities. And the fantastic thing is that they really are quite easy to spot because of these two converging trend lines. So wherever you get the market settling into a choppy range like this, look to see if you can identify these converging trend lines. And if you can, then that gives you a triangle pattern, and you know that you're likely on the verge of quite an explosive move afterwards. And you can see that the move here out of the triangle, although it was a little choppy, it was actually a very large move indeed, and gave the opportunity for very good profits. So again, another fantastic structure you can look to use with your breakout trading. Okay, and then finally, one of the aspects of breakout trading that we need to discuss, which is perhaps one of the most underutilized but actually most effective approaches you can take, is trading the retest after the breakout. So breakouts tend to be very volatile moves that often see an explosive initial move, and while there are many instances where price continues to trade in the direction of the breakout, taking off like a bullet from a gun and just doesn't look back, in most instances, or in many instances, what you will see is a situation where price breaks out of the range and then pulls back and retests the range before then taking off again, trading in the direction of the breakout. So let's just take a look at an example of this then. Okay, so here you can see we've got this really well-defined resistance level in the euro yen. So we've had 3 massive touches at this level with price simply unable to break above it. So we have our resistance level in play. We're looking for price to break out to the top side. You can see that price does indeed break out to the top side here. We close above the high of the range here. So conservative traders are able to enter there if they like. You can see that we then make an initial move to the top side strongly. However, then what happens is price reverses, trades lower, and we actually retest that broken high, and then you can see the broken high actually becomes support now, and then price takes off to the top side. So the reason why this changes is simply due to the order flow dynamic. And for those of you who were in the support and resistance webinar, this is something we talked about a lot. So where we get a buildup of orders to sell called resistance, in order for that resistance to be broken, we know that buying power has to overwhelm selling power. So once price is broken above that resistance level, we know that there are now more buyers in the market than sellers at this level. And so if price subsequently retests that level, we can anticipate that it's going to act as support instead of resistance, because now we have more demand at that level instead of supply. So the thing is, in terms of how this is important to breakout trading, essentially this acts as the line in the sand, the pivot for whether or not the trade is going to work. So once price is broken out of our range, if price then trades back down and retests the range, this is the make or break point. Either this is going to hold and price is going to continue the breakout, or this is going to fail and that was going to be a false breakout. So one school of thought is that instead of looking to enter a trade on the initial move, on the initial breakout, you can be even more conservative and wait for price to trade back down, retest the broken range, and then if it holds, you can look to enter then. So one of the things, so there are two things with this. One is you might miss some moves, okay? There will be instances where price breaks out and simply takes off, never retest the range, and you missed a shot. But the thing to remember is it's always about managing your risk and looking to trade in a style that suits you. So if you are a conservative trader, then looking to trade a retest of the broken range might be a style that suits you more. And the thing is, once price has retested that range and held, you know that there's a strong likelihood that the trade is going to work, so you can feel a bit more secure about taking the trade. Okay, so in terms of then how we enter these trades and in terms of how we manage them, the great thing about using this style, so using the retest, is that we actually get a natural point to put our stop. Okay, so price trades up to this high point here, we trade back down, we retest the range holds and price reverses and trades higher. So now what we're actually looking at trading is a mini breakout in the direction of the trend, in the direction of the initial breakout, okay? So we broke out to the top side, put in our high, price reversed, traded lower, retested the range holds. As price turns higher again, we can then look to trade as price breaks above that high. And as I say, we've got a natural apex here where we can put our stop. So we can put the stop below that swing low, and then again we're just looking to target 2 times our risk. So this is a really fantastic way to really capitalize on the natural ebb and flow of the market, and hopefully you can see it's quite beautiful in terms of how you're able to read the market and identify these setups, because you're using the natural structure of the market to your own advantage here in terms of how to read a trade, how to enter a trade, and how to manage a trade. So in terms of trading these breakouts, then we've identified that you can either put your orders resting outside the range boundary and wait for the market to tag you in, but the risk here is that you might get sucked into a false breakout. Alternatively, you can wait for a candle close, which gives you a little bit more confirmation, but similarly you might still suffer a false breakout. Or you can wait for price to trade above the range or below the range if it's a breakdown for a bearish trade. Wait for price to then retest the broken range, and then wait for the market to show you that the range is holding, and then as it moves back in the direction of the breakout, you can go ahead and enter your trade. Okay, now one final way in which you can actually enter these trades is by entering at the retest of the range, and here you can see that using price action confirmation again is the best way to do it. So where price trades back down and retests this broken resistance, you can see we actually get a bullish pin bar form. So for those of you who were in the candlesticks webinar, you'll know that a bullish pin bar is a classic bullish reversal candle which signals a sharp shift in sentiment in the market and the likelihood of a bullish move. So where price is retesting this level, which we now anticipate will hold as support, once we identify the presence of a bullish reversal candle there, we can take this as a strong signal that the level is likely to hold, and we can go ahead and enter long. So hopefully now you can see that although breakout trading is an incredibly simple straightforward approach to trading the market, it is quite multifaceted, and hopefully what I've highlighted to you are some of the very common mistakes that a lot of new traders make and why breakout trading can sometimes get a bad rap. And we've looked at some of the ways you can protect against the downsides and the pitfalls of breakout trading, and also some ways in which you can improve your chances of success with your trading, looking at the indicators, looking at trading with the trend, looking at waiting for price action confirmation, and finally looking at waiting for trading a retest of the breakout. Okay, so just before we wrap up then, I'm just going to check because there were a few questions coming in then, so I'll just go back through and answer some of those. I didn't want to stop because I could see the questions coming in. I thought it was better just to cover the content and then look back. So yeah, when looking to take an entry on a breakout trade, typically I prefer to wait for price to close, for the candle close outside of the range. So if you're trading a bullish breakout, you wait for a bullish candle to close above the top of the range. If you're trading a bearish breakout, you look for a bearish candle to close below the low of the range. How do you know when to close a breakout position? So obviously, in terms of how you manage your positions, it's completely down to you. But as a minimum, what I'm always looking for with my own trading is looking for a minimum of 2 times risk. So if you're a trader who likes to simply take trades, get in and out of the market, then you can look for very defined targets like that. Alternatively, if you're looking to manage trades longer term, then you can look to do stuff like trailing your stops, using either structural, so swing highs and swing lows, or using indicators such as moving averages or the parabolic stop and reverse indicator. So if you're looking to manage your trades, then it's really about how you keep yourself in the market for longer to let the trades play out. In terms of how you use the breakout for intraday, Raj, so you can use the breakout methods that we've discussed here on any time frame. That's another one of the really great things about them, is that regardless of whether you trade on the higher time frames or the lower time frames, these methods are applicable. All you have to remember is the lower time frames are of course a lot noisier, and the actual outcomes will be a lot shorter in terms of the targets that you play for. And then on the longer term trades, the trades can take a lot longer to set up and a lot longer to play out. But the methods are just as valid on the higher time frames as they are on the lower time frames. Okay, well look, that's been a really enjoyable webinar. It's been great to go back over breakout trading. As I say, it's one of the most widely used strategies in trading by both retail traders and institutional professional traders alike. So it's a really great method to try out if you haven't before. And for those of you who've been trading for a while, hopefully this was a nice refresher course on breakout trading. So thanks a lot everyone for joining me today, and thanks a lot for your contributions. The recording of this webinar will be posted to everyone who signed up for it, and I look forward to catching up with you all next time. Thanks a lot everyone. Goodbye.